The lines on the chart screamed at him. It wasn't just a pattern. To him, it felt like a ghost from a half-century ago, and its cold breath was fogging up the glass of the present. He was the only one who seemed to feel the chill. You will understand who that man is and what he was seeing in a moment, but first, you need to understand what the scenario looked like back then. The year was 1986. Outside the windows of his office, Wall Street was filled with ambition and cocaine-fueled optimism. The Dow Jones Industrial Average was flying like a rocket ship, punching through galaxies of wealth nobody had ever imagined. Every dip was a gift, a buying opportunity from a market god who only knew one direction, up. Fortunes were being minted daily, and the men making them were the new American heroes. They were young, handsome, and utterly convinced of their own invincibility. In this world, caution was a coward's virtue. To be bearish was to be a fool, an outcast who simply didn't get it. And then there was Paul Tudor Jones. At 32 years old, Jones was a product of this aggressive new era, but he was not entirely of it. He was a trader, and a damn good one, having sharpened his skills in the wild pits of the New York Cotton Exchange. He was intense, competitive, a man who vibrated with a nervous energy that could power a city block. But unlike the new breed of Wall Street titans who believed they were bending history to their will, Jones was a devout student of it. He believed history didn't just rhyme, it repeated itself with brutal, unforgiving precision. He believed that the market wasn't a line ascending to infinity, but a vast, violent ocean of human emotion, forever churning between the twin poles of greed and fear. And in the summer of 1986, he could taste the fear coming. He could smell the salt of the coming storm long before a single cloud appeared in the sky. His colleagues, his investors, even some of his own partners thought he was crazy. They saw his intensity not as focus, but as paranoia. They saw his deep dives into historical market data not as diligence, but as a morbid obsession. He would talk about risk, about capital preservation, about the moment when the music would inevitably stop. They would pat him on the back, smile condescendingly, and walk away to buy another 100 shares of a tech stock that had just doubled. "Paul's a great trader," they'd say, "but he's just too bearish. He's going to miss the big one." They laughed at his warnings, dismissing them as the anxieties of a talented but overly aggressive hothead who was destined to get steamrolled by the most powerful bull market in a generation. He was fighting the tape, and in the 1980s, that was financial suicide. But Jones wasn't just feeling anxious. He was building a case, piece by painstaking piece. He knew a gut feeling wasn't enough. To bet against the entire world, you needed more than intuition. You needed proof. He needed to find the ghost. So he did something that seemed utterly bizarre to his contemporaries. He hired a young analyst, a recent Columbia Business School graduate named Peter Borish. Jones gave Borish a single strange mandate: scour the annals of financial history. Find a market, any market, from any time in the past that looked and acted exactly like the U.S. stock market of the 1980s. He wasn't looking for something similar, he was looking for a perfect mirror. Borish dug in, sifting through decades of forgotten charts and dusty ledgers. He looked at the tulip mania, the South Sea bubble, the boom and bust cycles of the 19th century. Nothing was quite right. Then he found it. The analog was so perfect, so chillingly precise, that it sent a shockwave through their small office. It was the American stock market from 1927 to 1929, the Roaring Twenties. The similarities were uncanny, far beyond simple coincidence. Borish took the chart of the Dow Jones Industrial Average leading up to the Great Crash of 1929 and laid it directly over a chart of the current market. The fractal patterns, the rhythm of the advances and corrections, the very shape of investor euphoria, it was all there. The 1980s market was behaving like a perfect echo of the 1920s market, just on a larger, faster scale. It was as if a composer had rewritten his most famous symphony for a much larger, much louder orchestra. The melody was identical. Jones stared at the overlay, the two lines tracing the same catastrophic path. He saw the initial bull run, the speculative fervor, the period of consolidation, and the final, insane vertical ascent. This wasn't just an analysis, it was a script. It was a prophecy written in the universal language of numbers. According to the 1929 map, the market of 1986 and 1987 was entering its final, most dangerous phase, the blow-off top. The part where the rocket goes completely vertical right before it runs out of fuel and falls back to Earth in a ball of fire. The philosophy of the day was simple. Financial markets were efficient. All known information was already reflected in the price. The past was irrelevant. To look at a 60-year-old chart for guidance was, in their view, akin to using astrology to pick stocks. They believed in a new paradigm, one where hostile takeovers, junk bonds, and dynamic hedging strategies had rendered the old rules obsolete. Their philosophy was that the system was stable, that it would bend but never break. Paul Tudor Jones's philosophy was far simpler and much older, the rubber band theory. When a market gets stretched too far in one direction by the irrational force of human greed, it doesn't just gently return to its resting state. It snaps back with devastating violence. With Borish's analysis in hand, Jones now had his smoking gun. He began to talk more openly, more forcefully. He produced a documentary-style film for his investors, a film that would become the stuff of Wall Street legend. In it, he sat calmly at his desk and laid out his entire thesis. He narrated the parallels between the 1920s and the 1980s, showing the charts, explaining the psychology. He wasn't just predicting a correction, he was predicting a system-wide failure, a crash of historic proportions. He looked directly into the camera and told the people who had entrusted him with their capital, "There is no question that we are in the midst of a speculative bubble of historic proportions. The climax of this bubble will be a crash." The reaction was a mix of shock and amusement. Some investors pulled their money immediately. Others called him, pleading with him not to bet against the greatest bull market of their lifetime. His bosses and senior partners at his brokerage firm grew increasingly nervous. He was managing their money too, and his dark premonitions were becoming a liability. The laughter grew louder. They called him Cassandra. They called him Dr. Doom, a young, brilliant trader who had lost his nerve and was about to sacrifice a fortune tilting at historical windmills. The market, for its part, seemed to be doing everything it could to prove him wrong. Throughout late 1986 and into 1987, it just kept screaming higher. The Dow crossed 2,000 for the first time in January 1987, then 2,100, then 2,200. By August 1987, it was sitting at an all-time high of 2,722 points, a staggering 44% gain in just 8 months. Every day, the news trumpeted new highs and new millionaires. The party was louder than ever, and every single day, Paul Tudor Jones was becoming more certain that the end was near. The 1929 chart provided the what, but Jones's real genius was in understanding the how. He began to dissect the mechanics of the 1980s market, searching for the trigger. What new invention would cause the snap? He found it in something called portfolio insurance. It was a new, complex, computer-driven strategy sold by Wall Street's brightest minds. The pitch was simple. It allowed large institutional investors, like pension funds, to protect their massive stock portfolios from market downturns. The computers were programmed to automatically sell vast quantities of stock index futures when the market fell by a certain percentage. In theory, it was a perfect hedge. It was supposed to be a shock absorber for the entire system. Jones saw it differently. He saw a doomsday machine. He realized that all of these supposedly independent computer programs were programmed with the same basic instructions. If the market drops by X%, sell. If it drops further, sell more. What would happen, he wondered, if everyone ran for the same tiny exit at the same time? He realized portfolio insurance wasn't a shock absorber at all. It was an accelerant. It was a mechanism that would take a small fire and turn it into a firestorm. Once a sell-off began, the computers would kick in, selling futures. This would drive the market lower, which would trigger more computer selling, which would drive the market even lower. It was a perfect self-reinforcing death spiral, hard-coded into the very architecture of the market. Now he had it all: the historical precedent, the psychological profile of a speculative mania, and the technical mechanism for the collapse. The ghost on the chart wasn't just a warning anymore. It was a roadmap, and the map was leading to a cliff. While Wall Street partied, Paul Tudor Jones began to quietly, methodically, and with terrifying conviction assemble one of the largest short positions in the history of finance. He was going to bet against the entire United States stock market. He used the very instruments the portfolio insurers would be forced to sell: stock index futures, primarily the S&P 500 future. Shorting a future is a simple bet that the price of an asset will go down. It required relatively little capital up front, allowing for immense leverage. For every point the S&P 500 index fell, his fund would make a fortune. For every point it rose, he would suffer catastrophic losses. He was placing a bet that was, by some estimates, notionally valued in the billions of dollars. He wasn't just dipping his toe in the water, he was trying to drain the ocean. As August turned to September 1987, the market began to show signs of cracking. It stumbled. The rocket ship was sputtering. For the first time in years, the dips weren't being bought instantly. A sense of unease began to creep into the financial news. Jones held his position, his stomach in knots. He was early. The final manic phase of the bull run was still pushing stocks to irrational heights, and every tick up was costing his fund millions in paper losses. The pressure was immense. His investors were calling, panicked. His partners were pleading. The laughter from his peers had turned into angry, nervous whispers. He was either a madman or a prophet, and the line between the two was getting thinner with every passing day. He spent his days glued to the screen, his nights poring over the 1929 chart, looking for confirmation, for solace. The chart told him to be patient. The chart told him that the most violent moves often happen right at the end. It showed that after the initial peak in 1929, the market chopped around violently for weeks, shaking out the weak hands before the final terrifying plunge. And the 1987 market was following the script to the letter. By the first week of October, the market was clearly faltering. The Dow dropped 91 points in a single day, the largest one-day point drop ever at the time. The media started to use the word correction, but for most, it was still just another buying opportunity. The buy-the-dip mentality was too deeply ingrained. But for Jones, it was the beginning. The sound of the rubber band stretching to its absolute limit. He didn't reduce his short position, he added to it. He increased his bet, pressing it with a gambler's instinct backed by a historian's certainty. He picked up the phone, his heart pounding not with fear, but with a terrifying clarity, and prepared to bet everything he had on the end of the world. The voice on the other end of the line was tight with a mixture of awe and terror. Jones was telling his brokers to sell more, to short the market with a ferocity that defied all logic. Even as the market began to bleed, the muscle memory of a 5-year bull run was screaming at everyone to buy. Jones was ordering them to pour gasoline on the fire. He wasn't just predicting the crash anymore. He was positioning himself to ride the explosion. He was placing the detonators. The first week of October was a bloodletting. The market fell day after day, shedding hundreds of points. The confident swagger on Wall Street was gone, replaced by a nervous, twitchy energy. The laughter aimed at Paul Tudor Jones had died in their throats. Now, when they saw him, they saw a phantom, a man who seemed to be in communication with a darker reality they couldn't perceive. His bearishness was no longer a joke. It was starting to look like an indictment. But the true believers, the high priests of the bull market, held the line. "This is healthy," they proclaimed on the evening news. "A much-needed consolidation before the next leg up to Dow 3000. They spoke with the forced confidence of men trying to hold back a flood with a picket fence. Jones and his small team at Tudor Investment Corporation worked in a state of heightened reality. Sleep was a luxury. Food was an afterthought. Their entire world had shrunk to the flickering green numbers on their Quotron screens and the dog-eared 1929 chart pinned to the wall like a sacred text. Peter Borish, the analyst who had discovered the ghost in the machine, was now a field marshal in Jones's army, constantly running new calculations, confirming the terrifying symmetry between the past and the present. Every lurch downwards in the 1987 market was eerily preceded by a similar move on the 1929 chart. They were no longer just tracking a pattern, they were living inside of it. Then came the week that would break the world. On Wednesday, October 14th, the dam began to crack. News hit the wire that the House Ways and Means Committee was advancing a bill that would limit tax deductions for debt used in corporate takeovers. This was the fuel that had powered the 1980s boom. Leveraged buyouts were built on mountains of debt, and the idea that this pillar of the new economy could be kicked out sent a shockwave of panic through the market. The Dow plunged 95.46 points, a record at the time. The floor of the New York Stock Exchange, a place of unassailable confidence just weeks earlier, was a maelstrom of fear. Traders stood stunned, their faces pale, watching billions of dollars in wealth evaporate in a few hours. For Paul Tudor Jones, this was the signal. It wasn't just random volatility anymore. The market had become so fragile, so dependent on easy credit and corporate rating, that a single piece of legislative news could trigger a panic. The rubber band was stretched to its breaking point. That night, while other fund managers were on the phone with their clients, calming them down and assuring them the worst was over, Jones was on the phone with his brokers, sharpening his blade. Thursday, October 15th, offered no relief. The selling continued, a cascade of fear as big institutions began to lighten their positions. The market dropped another 58 points. The cumulative effect was devastating. The psychology of Wall Street was shifting in real time. The belief that stocks only went up was being systematically dismantled. For the first time, people began to contemplate the abyss. Could it happen again? Could a real crash, a 1929-style crash, actually happen in the modern, computerized, sophisticated world of 1980s finance? The question, once unthinkable, was now being whispered in terrified tones. Friday, October 16th, was the day the floor gave out. It was a triple witching day, a quarterly event where stock index futures, stock index options, and stock options all expire on the same day, typically leading to massive volume and wild price swings. The day began with a wave of selling that quickly turned into a deluge. The portfolio insurance programs, the doomsday machines that Jones had identified months earlier, were beginning to stir. As the Dow fell through key technical levels, these automated programs began to execute their pre-programmed sell orders. They weren't selling stocks, they were selling S&P 500 futures in Chicago, which created a vicious feedback loop. Here's how the machine worked. A pension fund in California owned billions in stocks. To ensure it, their computer model watched the S&P 500. When the S&P 500 fell, say 3%, the computer would automatically sell a corresponding amount of S&P 500 futures to hedge their position. But the futures market and the stock market are inextricably linked. When professional arbitrageurs in Chicago and New York saw the futures price dropping below the actual price of the stocks in the index, they would perform a simple trade: buy the cheap futures and sell the expensive stocks. This action, repeated thousands of times a minute, drove the stock market itself lower. A falling stock market would then trigger the next round of portfolio insurance selling in the futures market, and the cycle would repeat faster and faster. On Friday the 16th, this death spiral began its first terrifying rotations. The Dow hemorrhaged another 108 points, capping off the worst week in the history of the stock market. Over 500 points had been wiped away in a matter of days. The closing bell on Friday didn't bring relief. It brought a profound sense of dread. The market had closed near its absolute low for the day, a sign of extreme weakness. More importantly, it had closed below the critical trigger points for almost every major portfolio insurance program in the country. Paul Tudor Jones and his team knew exactly what this meant. Over the weekend, while the rest of Wall Street prayed for a miracle, the computers at firms like LOR Associates and Wells Fargo Investment Advisors were crunching the numbers from Friday's close. Their programs, emotionless and implacable, came to one conclusion. At the opening bell on Monday morning, they were required to sell. Not just sell a little, they were required to sell billions upon billions of dollars worth of stock futures, instantly, regardless of price. A tidal wave of institutional selling was poised just over the horizon, aimed directly at the heart of the market, and almost no one else saw it coming. The creators of portfolio insurance themselves were convinced their models were sound. In a classic case of intellectual hubris, they believed that if everyone used the same insurance, the market would be safer. They failed to account for the simple, deadly paradox. You cannot insure against a risk that everyone is trying to hedge at the same time. It's like selling fire insurance to every single person in a city, knowing that if one house catches fire, they all will. Over that weekend, a strange calm descended on Jones's office. The frantic energy of the chase was over. The thesis was no longer a theory, it was a certainty. All that was left was to witness the event itself. Jones felt the crushing weight of being right in a way that would cause immense pain to millions of people. There was no joy, no celebration, just a grim, focused resolve. He was famously quoted as saying that at that moment, all he wanted to do was go to a desert island with a case of champagne and a case of canned tuna and just wait for it all to be over. He was about to make more money in a single day than his heroes from the trading pits had made in their entire lives. But it felt less like a victory and more like surviving an apocalypse he knew was coming. Around the world, the stage was being set. A freak hurricane had shut down the London market on Friday, meaning a backlog of sell orders would be hitting Europe as soon as it opened. The Tokyo market, which opened before New York, was already showing signs of extreme stress. Global markets were now linked by technology in a way they had never been in 1929, ensuring that the panic would be a global contagion, spreading across time zones like a virus. Sunday night, Jones barely slept. He went over the plan with his team again and again. How would they manage the position? How would they exit? In the chaos of a crash, getting out of a massive winning trade can be just as difficult as getting in. Liquidity would vanish. Counterparties could default. The entire financial system could seize up. Making $1 billion on paper meant nothing if you couldn't actually collect it. Meanwhile, the official narrative being spun by the Wall Street establishment was one of cautious optimism. The Secretary of the Treasury, James Baker, appeared on Sunday morning talk shows to reassure the public. He hinted that the U.S. might be willing to let the dollar fall to pressure Germany on interest rates. a comment that would later be blamed for spooking foreign investors. But for the most part, the message was, stay calm, the professionals are in control, the markets are resilient. They had no idea what was waiting for them. They thought they were facing a storm. Paul Tudor Jones knew they were facing a black hole, an event horizon of forced, computerized selling from which no light or capital could escape. His bosses, the ones who had laughed at his obsession with a 60-year-old chart, were now facing margin calls that threatened to bankrupt their firms. His peers, the ones who had mocked him as a paranoid bear, were staring into the abyss of a market that had stopped making sense. The rubber band had been stretched for 5 long years. It had been pulled taut by greed, arrogance, and a blind faith in new technology. And as the sun rose on the morning of Monday, October 19, 1987, it was about to snap with a sound that would echo through financial history forever. The opening bell on the New York Stock Exchange rang at 9:30 a.m. Eastern Time. It was not a bell, it was a detonation. The moment trading began, the market didn't just open lower, it ceased to exist in any recognizable form. A phantom market appeared in its place, one that was hundreds of points below Friday's close. The digital quote systems, which had been the proud symbols of Wall Street's technological prowess, simply froze, unable to process the sheer volume of sell orders flooding the system. Traders on the floor of the NYSE stood in open-mouthed horror, staring at blank screens. There were no bids, only sellers, a universe of sellers, all screaming into a void. In Chicago, at the Mercantile Exchange where the S&P 500 futures were traded, the scene was even more apocalyptic. This was ground zero. This was where the portfolio insurance computers were aiming their multi-billion-dollar fire hose of sell orders. The futures market, designed to be more liquid and faster than the stock market, became the epicenter of the collapse. The S&P 500 futures opened limit down, meaning they had fallen so far, so fast, that exchange rules automatically halted trading to prevent a complete meltdown. But this safety mechanism had the opposite effect. It was like closing the only fire escape in a burning building. The institutional sellers, legally and contractually obligated to sell, were trapped. Their panic intensified. Paul Tudor Jones and his team were watching this unfold not with panic, but with the grim focus of surgeons in a chaotic emergency room. Their thesis, born in the quiet study of a historical chart, was now a terrifying living entity, and it was tearing the global financial system apart at the seams. Jones knew this was the moment of maximum danger and maximum opportunity. His short position was already generating astronomical paper profits, but the number was meaningless. The entire system was breaking. The stock market had become a black box. No one knew what the real price of anything was. The ticker tape, which normally reported trades in seconds, was running hours late. You could place an order to sell your stock and have no idea what price you got until after the market closed. It was a complete breakdown of information. The specialists on the floor of the NYSE, the men whose job it was to maintain an orderly market by buying when others were selling, were simply overwhelmed. They were being hit by a tsunami of sell orders from every pension fund, mutual fund, and insurance company in the country. Their capital reserves were being vaporized in minutes. Iconic American companies, IBM, Coca-Cola, General Electric, saw their stock prices collapse as if they were worthless penny stocks. The price of IBM fell from over $130 to nearly $100 in the first hour of trading, wiping out tens of billions of dollars in market value. But the real prices were a mystery. The entire market was trading in the dark. Jones had an advantage. Because he had anticipated the mechanics of the collapse, he knew where the real action was. It wasn't on the paralyzed floor of the NYSE. It was in the futures pits of Chicago. He had traders stationed there, screaming their orders in the pandemonium. While the stock market was blind, the futures market, despite the trading halts, was offering brief, fleeting glimpses of reality. And the reality was a bottomless pit. He gave his team a simple, powerful instruction. Borish's 1929 chart had predicted the what. His analysis of portfolio insurance had predicted the how. Now, he used the 1929 chart to predict the how much. He and Borish calculated the percentage drop of the 1929 crash and applied it to the 1987 market. The number they came up with was shocking, but they trusted the map. The chart told them where the bottom was likely to be. It gave them a target in a world where every other landmark had been obliterated. While everyone else was selling in a blind panic, Jones was preparing to do the opposite. He was preparing to buy. This was the final, critical piece of his genius. It wasn't enough to predict the crash. You had to know when to take your profits and get out. He knew that at the moment of maximum fear, when the last seller had been flushed out in a torrent of margin calls and forced liquidations, the market would stage a violent reversal. The rubber band wouldn't just snap back, it would whip back in the other direction with incredible force. His plan was to cover his massive short position at the very bottom of the crash, and then, in a move of unbelievable audacity, immediately go long, betting that the market would bounce. He was planning to surf the tsunami down and then ride the rebound wave back up. By midday, the situation had deteriorated into pure chaos. The Dow was down 200 points, then 300. The numbers were so large they seemed unreal. Stories began to trickle out of Wall Street firms on the brink of collapse. Margin calls were going out by the thousands. People who had borrowed money to buy stocks were being told to either put up more cash immediately or have their positions liquidated at whatever catastrophic price the market would offer. Fortunes built over lifetimes were being extinguished in a matter of hours. The greed is good generation was learning the brutal lesson of leverage. The same leverage that had made them rich was now making them poor at 10 times the speed. In his office, Jones was a vortex of calm intensity. He was on the phone with his brokers, his floor traders, getting real-time intelligence from the pits. He was ignoring the news, ignoring the politicians who were now appearing on television with panicked looks on their faces. He was focused on one thing and one thing only, the price. The price of the S&P 500 future. The moment of peak panic arrived shortly after 1 p.m. The selling reached a fever pitch. The portfolio insurance programs, having been thwarted by the initial trading halts, found ways to get their sell orders to the floor. It was a relentless, machine-driven liquidation. The Dow plunged past 400 points down, then 500. The percentage drop was now approaching the scale of 1929. This was it. The moment Jones had been waiting for since he first saw the ghost on the chart. While the world was selling, Paul Tudor Jones began to buy. He gave the orders to start covering his short positions. For every futures contract he had sold short, he now had to buy one back to close the trade. He was providing a bid in a market that had none. He was absorbing the panic of the entire world. His orders were so large that traders in the pit later said it felt like a single giant hand had appeared out of nowhere to stop the market from falling to zero. The numbers were staggering. The Dow Jones Industrial Average ultimately closed down 508.32 points, a drop of 22.6%. It remains, to this day, the single worst one-day percentage loss in the history of the index. Over $500 billion in wealth was destroyed in 6.5 hours. It was more than the total value of all the goods and services produced by West Germany, the third largest economy in the world at the time. The event was immediately christened Black Monday. And in the wreckage, Paul Tudor Jones stood virtually alone, untouched. Not only had he survived, he had triumphed on a scale that was difficult to comprehend. His fund, Tudor Investment Corporation, reportedly netted a 62% gain for the month of October. As the market collapsed, his fund's value had soared. He had personally made an estimated $100 million in a single day. In one of the most famous trades in financial history, he had shorted the market at the top and then covered his short and bought the market at the absolute low of the day, reportedly capturing 90% of the entire day's trading range. The aftermath was a wasteland. The Wall Street titans of the 1980s were broken men. The firms that had laughed at him were either bankrupt or begging for bailouts. The high-flying traders who had dismissed him as a paranoid crank were wiped out, their careers and fortunes incinerated. The creators of portfolio insurance, the academic geniuses who were so sure of their models, were disgraced. Their invention, designed to prevent a crash, had instead been the engine of its creation. They had built the perfect doomsday machine without ever understanding that they were the ones who would be caught in the blast. Overnight, Paul Tudor Jones went from being a talented but eccentric trader to a Wall Street god. He was no longer Cassandra, he was a prophet. The documentary he had made for his investors, once seen as a curiosity, was now treated like a holy relic, passed around on Wall Street in secret VHS copies. Everyone wanted to know, how did he do it? How did one man, with one simple idea, see what the entire financial establishment, with its supercomputers and PhDs, had missed? The answer was as simple as it was profound. They had all been looking at the present, convinced of their own genius and the infallibility of their models. They believed they had tamed risk. Paul Tudor Jones had been looking at the past. He knew that the market was not a machine, but a mirror reflecting the unchangeable, cyclical nature of human emotion. He knew that greed always leads to excess, and excess always leads to fear. And he knew that the most important words in finance were not "this time it's different," but "history repeats itself." By finding that ghost on a 60-year-old chart, he hadn't just predicted the future, he had remembered it. His bosses were not laughing anymore. They were listening, in stunned silence, to the man who had stared into the abyss and bet that it would stare back. The silence was deafening. In the days following Black Monday, a traumatized Wall Street walked on eggshells, fearing an aftershock that could shatter what little remained. The opulent restaurants of Lower Manhattan were morgues. The trading floors, once cauldrons of testosterone and bravado, were now populated by hollow-eyed men who looked like they'd seen a ghost. And, in a way, they had. They had seen the ghost of 1929. The one Paul Tudor Jones had been trying to warn them about all along. Suddenly, everyone wanted to talk to him. Reporters from the Wall Street Journal, the New York Times, and Fortune magazine camped outside his office. Rival fund managers, the very ones who had dismissed him as a doomsayer, were now desperately trying to get him on the phone, hoping a little of his foresight might rub off. He was no longer just a successful trader. He was an oracle. He had achieved the rarest of feats in the world of finance. He had been proven right in the most spectacular, undeniable, and profitable way imaginable. But Jones didn't take a victory lap. He didn't appear on television to gloat or write a best-selling book about his triumph. He did the opposite. He became intensely private, almost reclusive. He understood the fickle nature of the markets and the public. To be hailed as a genius one day was to be set up as a fool the next. He had seen the abyss, and while it had made him a legend, it had also instilled in him a profound and permanent sense of humility before the power of the market. He knew he hadn't controlled the crash. He had simply understood it better than anyone else. He had been a student of history, not its master. His focus immediately shifted from capitalizing on the crash to navigating its treacherous aftermath. The Federal Reserve, under its new chairman, Alan Greenspan, had sprung into action in the hours after the close on Black Monday. Greenspan issued a now famous one-sentence statement affirming the Fed's readiness to serve as a source of liquidity to support the economic and financial system. It was a promise to print money, to do whatever it took to prevent the financial market collapse from turning into a full-blown economic depression as it had in the 1930s. This intervention changed the game. Jones, ever the student of market dynamics, recognized this paradigm shift instantly. The crash was an event driven by flawed market mechanics and mass panic. The response was a deliberate, powerful act by the most powerful financial institution on Earth. He knew that fighting the Fed was a losing battle. While other bearish investors were doubling down, convinced that Black Monday was just the prelude to a deep recession, Jones began to unwind his negative bets. He had made his fortune on the collapse. Now he would preserve it by respecting the overwhelming force of the central bank's response. This ability to pivot, to discard a winning thesis the moment the underlying facts changed, was a crucial element of his success. He wasn't dogmatically bearish, he was a pragmatist. His loyalty was not to a particular worldview, but to the reality of the market as it was, not as he wished it to be. This flexibility would become a hallmark of his career, allowing him to thrive in bull markets, bear markets, and everything in between for the next 3 decades. The legend of his 1987 trade grew, taking on mythic proportions. The details, shrouded in secrecy, only added to the mystique. The film he made for his investors became one of the most sought-after pieces of financial media. Titled simply Trader, the documentary followed Jones through his daily routine, capturing his intensity, his obsessive focus, and culminating in his real-time reactions during the crash itself. The film was so revealing, so raw in its depiction of the emotional roller coaster of high-stakes trading, that Jones himself reportedly grew to dislike it. He felt it gave away too much of his thought process, his edge. He eventually bought up as many copies as he could find and took it out of circulation, which only made it more legendary. To this day, grainy bootleg copies are passed among young traders like a secret handshake. The core of Jones's philosophy, the one that the establishment had laughed at, now became the new gospel on Wall Street. Risk management, once a sleepy back-office function, was suddenly the most important discipline in finance. Everyone wanted to know how to protect themselves from the next Black Monday. The phrase capital preservation became a mantra. Jones had always preached that the most important part of trading wasn't how much you made when you were right, but how little you lost when you were wrong. Before the crash, this sounded like the timid advice of a coward. After the crash, it sounded like the wisdom of a survivor. He famously distilled his trading rules into a series of simple, powerful maxims. Don't be a hero. Don't have an ego. Always question yourself and your ability. He viewed every position he took not as a potential winner, but as a potential loser, and he obsessed over his exit strategy before he even entered a trade.
He would say, "I'm always thinking about losing money as opposed to making money." This defensive crouch, this inherent respect for the market's ability to inflict pain, was what separated him from the legions of traders who had been wiped out. They had been focused on the reward. He was obsessed with the risk. The story of the 1929 chart overlay became the central pillar of his legend. It was a perfect parable for the age. In a world increasingly dominated by complex algorithms and quantitative models, Jones had used simple, elegant historical analysis to see the truth. It was a victory for the humanist over the machine. It demonstrated that while markets are made of numbers, they are driven by people, and human nature, the primal dance of greed and fear, is constant. It doesn't change from one generation to the next. The technology changes, the names of the stocks change, but the emotional patterns of a bubble and a bust are timeless. Peter Borish, the young analyst who found the pattern, also became a star in his own right, eventually rising to become Jones's second-in-command before leaving to start his own successful firm. Their work together became a case study at business schools around the world on the power of analogical reasoning in finance. The impact on the market itself was profound. The portfolio insurance strategy was utterly discredited overnight, its name forever linked with the catastrophe it had caused. In its place, new mechanisms were introduced to prevent such a rapid, uncontrolled collapse from ever happening again. The exchanges implemented circuit breakers, rules that would automatically halt trading for a period of time if the market fell by a certain percentage. These were designed to give human traders a chance to catch their breath, to break the feedback loop of computerized selling and allow cooler heads to prevail. In a very real way, the entire regulatory structure of the modern market was built on the lessons learned in the wreckage of Black Monday, the very wreckage that Jones had seen coming. In the years that followed, Paul Tudor Jones used the capital and the reputation he had earned to build Tudor Investment Corporation into one of the most successful and enduring hedge funds in the world. He became a pioneer of the global macro style of investing, making large leveraged bets on the movements of currencies, interest rates, and stock markets around the globe. He made another fortune betting against the Japanese stock market bubble in the early 1990s and continued to post spectacular returns year after year. He also became a major philanthropist, founding the Robin Hood Foundation, which applied his data-driven, market-based principles to fighting poverty in New York City. He attacked philanthropy with the same intensity and analytical rigor that he brought to the markets, demanding measurable results and accountability from the charities he supported. He had made his name and fortune by capitalizing on systemic failure. He would spend a significant portion of it trying to fix the systemic failures of society. But the shadow of 1987 would always define him. It was his origin story, the event that forged his reputation and his philosophy. It was the ultimate "I told you so" in a world where being right is the only thing that matters. The laughter of his bosses had been the soundtrack to the greatest speculative mania of a generation. The silence that followed was the sound of his vindication. He had become a god on Wall Street, not because he was smarter than everyone else, but because he was wiser. He had understood a simple, timeless truth that his contemporaries, in their arrogance, had forgotten: that those who do not learn from history are doomed to repeat it. And for those who do learn, history offers not just lessons, but a roadmap to a fortune. He had found that map and followed it to the edge of the financial world and back. The map, however, was not a static document. Jones understood that history's power lay not in exact repetition, but in its rhymes and echoes. The 1929 analog had been a near-perfect guide for the 1987 event, but the next crisis wouldn't be an identical twin. It would be a cousin, sharing the same DNA of human folly, but wearing different clothes. His life's work after Black Monday became a continuous, obsessive hunt for these historical parallels. A search for the ghosts of markets past to illuminate the risks of markets present. This hunt required a deep and eclectic understanding of how the world worked, far beyond the narrow confines of financial statements and economic data. Jones became a voracious consumer of information, devouring everything from central bank reports and geopolitical analyses to sociological studies on crowd psychology. He built a team around him that reflected this worldview, hiring not just business school graduates, but historians, political scientists, and even meteorologists, believing that insight could come from anywhere. He was building an intelligence agency whose sole purpose was to see the world more clearly than anyone else. His trading floor was legendary for its intensity and its unique culture. It was a place of intellectual combat where ideas were mercilessly challenged. Jones fostered an environment where being wrong was acceptable, but not having a well-researched, deeply held conviction was a cardinal sin. He wanted his traders to think like principals, to have skin in the game, but to hold their own egos in check. He famously papered the walls of his office with inspirational and cautionary quotes.
One of the most prominent was from the legendary trader Jesse Livermore, a man who made and lost several fortunes, including one in the 1929 crash. The stock market is never obvious. It is designed to fool most of the people, most of the time. This mantra, that the market's primary function is to deceive, was the cornerstone of his post-1987 philosophy. He saw every consensus view, every sure thing touted on Wall Street, as a potential trap. The 1980s consensus was that stocks only go up and that modern finance had conquered risk. That belief had led directly to the slaughterhouse. Jones trained himself and his team to be professional contrarians, to actively seek out the flaws in the dominant narrative. His job, as he saw it, was to find the single critical assumption upon which the entire market's confidence rested, and then to imagine a world in which that assumption was proven false. In the early 1990s, the dominant narrative was the invincibility of the Japanese economic miracle. Japan was the envy of the world. Its companies were buying up American landmarks like Rockefeller Center and Pebble Beach. Its stock market, the Nikkei 225, had soared to unimaginable heights, with the value of the land under the Imperial Palace in Tokyo said to be worth more than all the real estate in California. The consensus was that Japan was different. Its unique corporate culture, its government-industrial partnership, and its disciplined workforce had created a new, superior form of capitalism that was immune to the boom and bust cycles of the West. Jones saw something else. He saw a historical echo, not of 1929 America, but of every speculative bubble in history. He saw asset prices that had become completely detached from their underlying economic value. He saw absurdities, like golf club memberships trading for millions of dollars. He saw a market stretched taut by leverage and irrational exuberance. While the world was buying into the Japanese miracle, Paul Tudor Jones was quietly placing his bets against it. He began to aggressively short the Nikkei index. Once again, his timing was impeccable. The Japanese bubble popped in 1990, and the Nikkei began a long, brutal decline that would last for more than a decade, an economic malaise that became known as the lost decade. While international investors who had piled into Japan were wiped out, Jones's fund reaped another massive windfall. He had done it again. He had identified the consensus, recognized it as a bubble, and positioned himself for its inevitable collapse. The trade wasn't as dramatic or as sudden as his Black Monday call, but in many ways it was more intellectually satisfying. It proved that his methodology wasn't a one-trick pony. It was a repeatable process. The success of these trades solidified his position in the pantheon of Wall Street legends, alongside figures like George Soros and Julian Robertson. They were the original macro traders, lone wolves who roamed the globe with billions of dollars at their command, making huge directional bets based on their top-down view of the world. They were part economist, part historian, part psychologist, and part riverboat gambler. They were a different breed from the corporate raiders of the 80s or the quantitative analysts who had come to dominate the 2000s. Their edge was not in complex mathematics or corporate strong-arming, but in a superior understanding of history, politics, and human nature. Jones's personal life also reflected this blend of intensity and deep thinking. He became an avid outdoorsman, a passionate hunter and fisherman who found solace and clarity in the natural world, far from the noise of the trading floor. He saw parallels between tracking an animal in the wild and tracking a trend in the market. Both required patience, discipline, pattern recognition, and the ability to strike with decisive force at the right moment. He believed that the time spent in nature helped him disconnect from the short-term emotional swings of the market and maintain a clearer, long-term perspective. He also became a fierce advocate for conservation, particularly in places like the Florida Everglades and the Serengeti in Africa.
He applied the same data-driven approach to his environmental philanthropy as he did to his poverty work, funding scientific research and backing projects that offered measurable results. It was another reflection of his core philosophy: understand the system, identify the key leverage points, and apply resources with overwhelming force to achieve a specific outcome. Whether the system was a financial market or an ecosystem, the intellectual process was the same. As the years went by, the financial world changed around him. The rise of the internet created a new speculative bubble in the late 1990s. High-frequency trading firms began using algorithms to execute millions of trades in milliseconds. The world became more complex, more interconnected, and faster than ever before. But through it all, Jones's core principles remained his anchor. He continued to study history, continued to manage risk obsessively, and continued to hunt for those moments when the market's consensus view was most detached from reality. He wasn't always right, he had losing years. He made bets that went against him. But his rigorous risk management meant that his losses were always contained. He never allowed a single bad trade to take him out of the game, a lesson he had learned from studying the lives of traders like Jesse Livermore, who had won fortunes only to lose them through hubris and overbetting. Jones's primary goal was longevity. He wanted to survive, to stay at the table, because he knew that massive history-making opportunities like 1987 only come along a few times in a generation. The key was to be ready and solvent when they did. His legend became a teaching tool. New traders at his firm were required to study the 1987 trade, not as a story of a great victory, but as a case study in process. They had to understand the historical analysis, the identification of the flawed market mechanic in portfolio insurance, the psychological discipline required to hold the position, and the tactical brilliance of the exit strategy. It was a masterclass in how to combine deep historical knowledge with ruthless, real-time execution. The story of the bosses who laughed at him served as a permanent reminder of the dangers of institutional groupthink. It showed how easily intelligent, successful people can become blinded by a prevailing narrative. The laughter was the sound of an establishment so confident in its own worldview that it couldn't even conceive of an alternative. Jones's triumph was a triumph of the independent thinker, a testament to the power of one man with a well-researched contrarian idea to topple an entire intellectual edifice. He proved that in the world of markets, the crowd is often wrong, and the lonely voice of reason, backed by historical evidence, can sometimes be the only one telling the truth. His story became an inspiration for every young trader who ever felt that the market was irrational, for every analyst who ever saw a pattern that no one else did, and for every investor who ever had the courage to bet against the world. That courage, however, was not born of recklessness. It was the product of immense, almost monastic preparation. The image of Paul Tudor Jones as a swashbuckling market gunslinger, while romantic, misses the crucial point. He was not a gambler in the conventional sense. He was a meticulous risk manager who only placed a large bet when he believed the odds were overwhelmingly skewed in his favor. He was like a professional poker player who patiently folds hand after hand, waiting for that rare moment when he has a royal flush and his opponent is inexplicably going all in with a pair of twos. Black Monday was that moment. He hadn't created the hand, he had simply been the only one at the table who had studied the game deeply enough to recognize it for what it was. His legacy, therefore, is a dual one. On the surface, he is the ultimate trader's trader, the man who called the single greatest crash in modern history and made a fortune doing it. His story is a thrilling narrative of conviction and triumph against the establishment. But beneath that surface lies a more profound and enduring lesson, one that transcends the world of finance. It's a lesson about the nature of knowledge, the arrogance of the present, and the enduring wisdom of the past. The establishment that laughed at him in 1986 was not composed of stupid men. They were the best and brightest of their generation, graduates of the finest universities, armed with the most advanced financial theories of the day. Their failure was not one of intellect, but of imagination. They were trapped in the eternal present, convinced that the rules of their time were permanent and universal. They saw history as a collection of quaint, irrelevant stories, not as a live database of human behavior and systemic fragility. They confused their complex models with reality itself, forgetting that a model is only as good as the assumptions it's built on. Their core assumption, that markets are rational and self-correcting, was about to be proven catastrophically wrong. Jones, by contrast, operated from a place of deep skepticism. He assumed the market was inherently irrational because it was made up of irrational humans. He assumed that systems, especially complex financial systems, were inherently fragile. And he assumed that the past was not just relevant, but was the only reliable guide to the future. By overlaying the 1929 chart, he was performing a simple but revolutionary act. He was asserting that the emotional state of investors in 1987 was fundamentally no different from the emotional state of their grandparents in 1929. The clothes were different, the technology was different, but the underlying greed and fear were identical. It was a deeply humanistic insight in a field that was rapidly trying to dehumanize itself with computer models and quantitative jargon. The Black Monday crash was a humbling event for Wall Street. It was a violent reminder that risk can never be eliminated, only managed. The idea of portfolio insurance was a perfect example of this hubris. It promised a risk-free way to participate in the market's upside, a financial holy grail. But as Jones understood, there is no such thing. The strategy didn't eliminate risk. It simply concentrated it and hit it, creating a single point of failure that brought the entire global system to its knees. The strategy was the financial equivalent of building a city in a dry riverbed because it hasn't rained in 50 years. Jones was the old man who remembered the stories of the Great Flood. They laughed at him right up until the moment the waters came. In the decades since, the lessons of Paul Tudor Jones and Black Monday have been learned and forgotten and learned again. The late 1990s saw the dot-com bubble, driven by a new set of new paradigm theories that insisted historical valuation metrics were obsolete. It ended in a crash. The mid-2000s saw the U.S. housing bubble, built on the supposedly risk-free foundation of securitized mortgages and the dogma that housing prices never fall. It ended in the global financial crisis of 2008, a cataclysm that dwarfed Black Monday in its economic impact. In each case, the pattern was the same. A period of prosperity and innovation leads to a belief that this time is different. A consensus forms, dismissing cautionary voices as relics of a bygone era. Leverage builds up in the system, often hidden within new, complex financial instruments that few understand.
And then, a catalyst, a small change in interest rates, a regulatory shift, a geopolitical event, pricks the bubble, revealing the entire edifice to be built on sand. Paul Tudor Jones continued to navigate these cycles, remaining one of the few constants in a constantly changing industry. He became an elder statesman, his opinions sought after by central bankers and presidents. He never lost his intensity, his deep-seated belief that a crisis was always just around the corner. This permanent state of vigilance, which his peers had once mocked as paranoia, was the very source of his longevity. While other legends of his era burned out, blew up, or simply faded away, Jones endured. His story is a powerful counter-narrative to the master of the universe mythos of the 1980s. The heroes of that era, both real and fictional, were men who bent the world to their will through sheer force of ego. Jones's power came from the opposite source, from humility. His willingness to submit to the evidence of history, to admit that he knew less than the accumulated wisdom of the past, was his greatest strength. He didn't try to bend the market to his will. He listened to it, understood its language, and aligned himself with its most powerful, primal forces. The laughter he faced was a critical part of his journey. It was the resistance that sharpened his conviction. It forced him to double-check his work, to build a case so irrefutable that he could withstand the psychological pressure of being a lone dissenter. Without the laughter, his thesis might have remained just a theory. The mockery of the establishment was the fire that forged his belief into the steel required to place a $10 billion bet on the end of a world.
In the end, the tale of Paul Tudor Jones and the 1987 crash is more than just a great financial story. It's a timeless drama about perception. It's about one man who looked at a roaring bonfire of prosperity and saw not the light and the warmth, but the instability of the fuel and the certainty that it would eventually burn out. Everyone else was dancing in the light. He was preparing for the darkness. When it came, suddenly and without mercy, he was the only one with a lantern, a map, and a way out. He became a god, not by commanding the storm, but by being the only one who had bothered to read the weather forecast from 60 years before.